Fripp is the Vice Chair of Oikocredit USA's Board of Directors, and he's been on our board since 2011. Jesse works for triple bottom line development consulting firm ShoreBank International, where he's Vice President and leads the company's alternative delivery channels practice. SBI's ADC practice works with over a dozen national payment platform operators, third-party agent aggregators, commercial banks, microfinance banks, non-bank financial institutions, and microfinance institutions on 5 continents to design, finance, and build mobile and branchless banking enterprises that expand access to inclusive, safe, affordable, and accessible financial and non-financial services for low-income families, households, and micro and small enterprises. And so there's information about SBI's alternative delivery channels practice there, and we'll share that at the end as well. My name is Leah Gage. I work for Oikocredit USA, and I'll be fielding some questions after the presentation. And I'll ask that if you have a question, please type it in your chat window or raise your hand, and then we'll field those questions once Jesse's finished his presentation. So without further ado, I'm going to hand it over to Jesse here.
Great. Well, thanks, Leah, and thanks to you and Charlene and the team from Oikocredit USA, and for everyone who has taken the time out during their lunch or breakfast or dinner or whatever time of day it may be, wherever you're dialing in from across the country and around the world, to join this conversation about financial inclusion and mobile banking. It's a real pleasure to be here wearing 2 hats, the one Oikocredit USA hat and my day job hat, working here with ShoreBank International, to share with you some perspectives from our experience at SBI, really working around the world, as Leah had so kindly introduced, in the area of financial inclusion and the emerging industry, really, of mobile payments and mobile banking, which is very hyped, often misunderstood and misinterpreted, and certainly fast-moving and complex, but with significant implications for the kind of things that we're all concerned about. I presume that many on the line are current or prospective investors in Oikocredit and or practitioners in the inclusive finance space, or certainly interested in the inclusive finance space. And so the topic is I think, a crucial one for the issue of inclusive finance, and we'll get into that hopefully a bit through the conversation today and through what I hope will be an active Q&A session. But maybe just to jump into it, I prepared a few slides, and not knowing sort of the background and of everyone on the line today, please forgive if perhaps I'm being too simplistic or too complex. Perhaps in the Q&A, if there are issues on either end of that continuum, we can clarify and correct them. I would like to maybe frame out a little bit theme in terms of the initial question of what is mobile and branchless banking. And essentially, we're discussing this as a distribution channel strategy for financial services delivery outside of traditional bricks and mortar infrastructure, and particularly speaking about, I can't really use I don't have my little electronic pointer. Oh, look at that! I do have an electronic pointer to really give a sense of sort of where in this overlapping series of areas that we're really wanting to focus in this conversation. E-banking might be familiar to many of us in the North American and European contexts, where we're very familiar with internet banking, which is quite prevalent, and increasingly something that's called mobile banking in North American and European contexts, but actually is essentially surfing your internet bank or accessing your bank website via your smartphone, which is essentially internet banking, but you're using a mobile handheld to do it. That's not what we're really be talking about today. Here we're really talking about using a low-tech, non-smart phone, what we call a feature phone, to enable financial transactions in emerging market economies primarily. There is overlap with the area of in-payments, which is we'll discuss a little bit today as one of the initial stepping stones to the broader mobile banking sort of universe. And this is where most of the initiatives that people might be familiar with across the world today are really focused is in the in-payments area. And one of the themes that we work on quite a bit and are quite concerned about is the importance of moving beyond payments into the full suite of financial and non-financial services that you can really deliver with these mobile channels. And then, of course, this universe here, the m-commerce, really is kind of an ecosystem effect that's often talked about and is still largely hypothetical, certainly in the emerging markets world, where you begin to see a movement away from cash as the primary means of transaction facilitation and into a true e-money or cash-light economy where transactions are really occurring in a digitized format consistently, even at the base of pyramid level of the economy. So hopefully that's a useful framing to give a sense of where we're going to be focusing, where I'll focus my initial comments this morning and then get into the Q&A for this afternoon. But why does it matter? Perhaps as a starting point. Many of us, myself included, have spent a good part of our careers focused on the microfinance field. Oikocredit International is certainly a leading social investor in the microfinance field, and many of you who are investors through Oikocredit USA have a real focus on that. However, we have to be realistic that after decades of focus, significant amounts of investment, microfinance reaches approximately, these are not specific figures, but approximately 200 million people, which is significant and has been a critical avenue for really raising the profile and the importance of the base of pyramid economies and individuals and households, but is really just scratching the surface in terms of the real need that remains. And that need is really quantified in the billions. 2.2 billion is the most current statistic that's commonly referenced in terms of people who are not able to access safe, secure, affordable, reliable financial services within the formal economy. And so that's obviously a major concern. Where we see the opportunity and where mobile really comes to play as a potential disruptive technology and in the positive sense is that of those 2.2 billion people, 1.7 billion of them currently own and use or have access to a mobile phone. So clearly you've got an important opportunity out there where the low-income households and clients have already incorporated the technology adaptation, and it's our job as investors, practitioners, people who are concerned about this to figure out the business models that will allow the use of that technology to provide access to financial services for those who are currently excluded. That said, I mentioned earlier that hype is certainly very high around the mobile money space. 110 implementations is probably on the low side currently. It's probably closer to 200. And we could probably count on one hand, maybe pushing into two if we really tried those that are successfully achieving scale and doing so in a financially viable manner. So it's still, again, with the hype, with all the activity, with the number of deployments that are occurring, we're still early days. And I think sometimes we talk a little bit about, putting things in context. If you look at the card industry started officially in 1953, I think, with the launch of the first Diners Club. And cards really have reached places like India, within the last 5 to 7 years. Mobile banking really came to fruition, at least in its first scale deployment, in around 2005, 2006 with M-Pesa in Kenya. So you kind of put it in the context of how cards have evolved as a medium for pushing banking beyond branches, and it's clear that we're still early days. But the other thing that's important to note too, and we'll get into this, is that of those implementations that are currently underway, most of them are essentially add-ons to telco platforms, mobile, particularly cellular communications providers, who have made significant investments in infrastructure, in distribution networks for airtime sales, and marketing and branding outreach. And they saw mobile money as really an easy add-on because there was no additional investment that was really required. That was certainly one of the drivers for M-Pesa. It was inexpensive. It encouraged customer loyalty because essentially when they cashed into the network, they were prepaying airtime. So obviously they didn't want to switch to another cellular provider and lose that prepaid airtime. It reduced churn, which is exactly what I just described, customers jumping from one cellular provider to another, and increased the average revenue per user for Safaricom, which is the cellular company that owns M-Pesa. But their objective wasn't and really isn't to provide financial services in the broader sense of it. Payments and transactions, particularly for telcos, transactions are the primary revenue generators, and so payment services were and are a very logical add-on to their core business and are consistent with their core business objectives. And that's one of the challenges that we work on every day at SBI, is how to expand that universe, not discounting the pioneering role that telcos have played in terms of establishing some of the payment platforms that are so critical to allowing this to happen, but bringing in additional partners, particularly banks and financial services providers, including microfinance institutions who are specialized in designing and delivering needed financial services beyond payments to unserved markets. And that's really where we're focused on improving outreach and strengthening the financial inclusion aspect of moving banking beyond branches. In the interest of ensuring that, and again, I apologize if there are experts in the area who are on the line, and this is something you've seen before, but I just wanted to touch on a little bit how it works at its very fundamental level. As I mentioned before, it leverages the existing technology and infrastructure that the mobile networks have deployed, and really gets it out into often very rural and unserved areas where it's not cost efficient to establish bricks and mortar branch networks. The critical element of almost any mobile payment network is what we call the agent network. And essentially that is a network, a distribution channel for putting cash into the system and taking cash out of the system that is built on very small, local, community-based businesses, such as the one you'll see here. This is a partner we work with in Bangladesh, bKash, who is credited here. Kamal Qadir is the CEO. They are the leading mobile payments platform in Bangladesh. You see their little sign there. And this is an average community agent in Bangladesh on the bKash network. And that makes access to the network extremely localized, completely convenient, and totally accessible for those who are using it. It really significantly, there's a number of studies that have been done and continue to be done with regards to how agent networks and mobile payments can break down the cost hurdles that have made it so challenging even for microfinance institutions, which have been very innovative over the years in trying to break down cost hurdles to delivery. But ultimately, the combination of agent networks and mobile technologies is proving to have the real potential to dramatically reduce the cost of acquiring customers and clients, delivering services, continuing to provide services on an ongoing level, and also incorporating feedback loops so that providers of those services can really get a very clear and highly localized understanding of what those customers actually want and what they need. And not we assume that they want and need, which is often a major challenge in the area of work that we're focused on in financial inclusion. So that's essentially how it works, and I think we have a little, I'm going to show you how a payment, a basic payment would work for Joe, the taxi driver. Joe, the taxi driver, is here in the bottom right corner. He has a cell phone, as you see. He lives in the city. He's trying to save money for a rainy day, but he's always out and about. He's got long hours. As most taxi drivers do, they're driving most of the day, and the bank schedules are not conducive to him having an account there, even if they would accept his small balance accounts. The bank is a forward-looking bank, so they've recruited agents, such as this one we see here, a small shopkeeper who really is open 24/7 in the community where Joe lives as a driver. And they see the value. They sell everything from rice to Coca-Cola to motor oil and wedding dresses and mobile money services. So Joe, when he's reached the end of his shift late at night or early in the morning before he goes out, he can go to his, there's something happening here, where Joe is covered. He can go to his shopkeeper friend and open a bank account through his mobile phone, we think. Yes. We're losing the arrows. Well, there's a little arrow that's supposed to go to the bank, but he can give his money to the shopkeeper, who then communicates through his mobile phone with the information from Joe's account to the bank. Joe is one of those folks that are happy people at the bank. One of his account is open there. And it moves from the agent's account at the bank to Joe's account. And then Joe gets a confirmation, real time. And this all happens within the space of most of these transactions, from account opening to initial transaction in most environments, depending on regulation, can happen within the space of 5 to 10 minutes, this entire transaction. So Joe gives his cash to the shopkeeper, confirmed, the account is reconciled at the bank, and Joe can go about his business knowing that he has money in his account that is safe, secure, earning interest, or in some cases not. It's a commitment account. Perhaps he's saving towards a specific objective or a match. In some cases, banks will offer. And he's on his way. Now, what happens when Joe needs to withdraw some money? He has a flat tire. He needs to fix his tire. He's on the road somewhere. He can't afford to have a lot of downtime. So he goes to a different agent that happens to be near where he's had his flat tire and tells the bank that he needs some money to go to that agent's account. The bank communicates to that agent's account that he needs to disperse some cash to Joe, and he does so quite happily, because the agent is earning a commission on these as well. Of course, a very small commission, but important for the agent. And Joe has his cash. He can fix his tire and go about his business. Now, this is a love story in the final analysis, because Joe's wife, Sally, lives in the countryside, as is so often the case in emerging market economies where we're working and deploying these types of initiatives. And Joe wants to be sure that he can send some part of his earnings on a regular basis back to Sally so that she can maintain the household, make sure the kids go to school, and essentially keep things running. When he needs to send her money, he does the same thing. He sends a communication to the bank, because he actually doesn't have to deal with the agent here necessarily unless he needs to put cash into the system. We assume that here he's already put cash in the system, so he can just, from his taxi cab, when he's stopped at a stoplight or maybe pulled off to the side because we don't want him texting while he's driving, he sends a notification, a message to the platform operator in the bank, and instructs them to transfer some funds from his account to Sally's account. Sally, off in the countryside, gets a notification that her account has just been credited, and when she wishes to, she can go to one of the many agents out in the village, send her notification to the platform operator that she needs to withdraw some cash from that agent. That notification then goes to the agent, who understands that he needs to hand over the cash to Sally. And that's essentially how a mobile payment works. Now we'll switch back from our high-tech video animation to really the broader theme. Because the payments, as I mentioned earlier, really is the first stepping stone. It's very important to create the beginnings of that ecosystem and to establish the channel. But payments really is only the first step. We often have conversations where people equate payments to, they say mobile payments equals mobile banking, and we beg to differ. Payments is an important part of banking, but actually banking includes a much broader range of products and services that people need, like savings, like credit, like insurance, merchant payments, bill payments, remittances, government transfers such as pensions and other types of transfers from the government. Humanitarian assistance has started to make very good use of mobile channels to streamline payments for emergency cash transfers, payroll transfers, and the like. And that's where we feel that, and we focus very strongly on building out that broader suite of products. A lot of it has to happen through partnerships, and that's again where the microfinance institution role can be very either as what we would call master agents or sort of operators and supporters to a group of these small shops who microfinance institutions typically know very well and often serve as clients, and can support with training and management of liquidity and their cash needs and so on, or as providers of products and services that are directly linked to a platform. And we do work with a number of microfinance institutions who are either engaged with or engaging with a platform operator to expand the universe of offerings that are available to their base of pyramid clients. An important part of what is happening in the space is regulatory. Regulation is a real critical part of mobile payments and mobile banking, and we see that it is not a homogeneous currently. There's a very, very broad range of regulatory environments, from sort of the frontier, open, completely unfettered environment, which is not necessarily a good thing, though it does allow for innovation. It doesn't protect consumers or clients from certain risks, to more clearly structured and focused regulatory environments, most of which are moving in the direction of strengthening the role of formal financial institutions as a key partner and really a grounding partner for mobile payment platforms, to ensure that there is accountability, that there is some protection and recourse, and that you don't inadvertently wind up creating, quote unquote, a second-class financial system for the world's second-class citizens, to be provocative about it. And that's something we certainly see as being important to avoid going forward, because of the strong potential value of this is indeed offset, as is often the case with new technologies and innovations, with a number of risks, some that are known, some that are unknown, and that we're still learning about. So there is a strong case, we feel, to be made for ensuring that partnerships are a key part of this, and that financial institutions who have expertise in designing and delivering financial products are a key part of these mobile platforms as they're rolled out. I think I'll kind of conclude with those comments. I know it's a very broad subject, and there's probably a lot of questions, but I think ultimately the final takeaway I would end on for the prepared comments portion of this conversation is that despite the hype, kind of alongside the hype, we are seeing progress. And whether platforms are the initial innovation or impetus comes from part of a telco or a bank or even a third-party private company, which is often the case, that's sort of intermediating between telcos, banks, and other partners. We are seeing the boundaries and horizons of financial access becoming more and more inclusive. There is innovation happening. If you look at markets like Pakistan, where we work, you see already that the number of mobile accounts that people are regularly leaving value on, saving on, is in the millions. And this is only a couple of years after really the first mobile payment platform was launched in Pakistan, and then in an environment where historically less than 10% of the population had financial sector access. And so we see real things happening, and with real implications for the low-income individuals and households that we're really concerned about. The transactions are safer. There is a greater awareness that the quote-unquote the poor, the base of pyramid clientele has sophisticated product needs, and they're often fairly localized. A client who's based in Karachi or Dhaka, even a neighborhood of Karachi or Dhaka, may have very different types of priorities than a client who is based in another neighborhood of the same city, or certainly in another region or more rural. And I think that's an important learning, and there are tools now being developed, many of them leveraging the same technology, to allow for a more informed, more focused approach to the real needs of the client, so that products and services can be tailored specifically to those needs. There is an increasing universe of competition. Here we note on this slide it particularly mentions banks, but I think it's equally true for microfinance institutions. Microfinance is really becoming, because of this technology, more of a segment, if you will, than sort of a classification that's outside of the universe of the formal financial system. And so I think we're already seeing a number of non-traditional players to the microfinance universe entering into to try to provide services to the base of pyramid individuals and households, and bringing new kinds of competitive pressures to bear on microfinance institutions. And we feel that microfinance institutions, because of their expertise, because of their focus, because of their mission, they do play a critical role and will continue to play a critical role in this new universe, emerging universe. But it also means that they're going to have to be very proactive. Investors are going to have to be very proactive and understand that it is a period of disruption, and there will be disruption to the microfinance institutions industry through this process as well. And I think it's important to prepare those institutions and their clients for that as responsible investors and practitioners and partners. But ultimately, the real prize is the real potential to achieve this goal of financial inclusion that we've been striving towards, certainly for decades. And it's not just financial inclusion, because the reality is that once a mobile payment platform is up and running, the incremental cost of adding other services, financial or non-financial, is very low. If you just think about the number of apps that you might be deluged with on your smartphone, you can understand what that potential might look like. Some of it's more constructive than others, perhaps, but certainly access to information, health, education, markets, those are critical opportunities to continue to enhance the capability of low-income households and individuals to build assets, to be more resilient to shock, and to improve their livelihoods and their families' health and well-being, and contribute to more stable economic and social realities in emerging market economies around the world. So with that, I think I'll close the structured remarks portion. Hopefully, we can get the Q&A to work. I think Leah, my colleague Leah, will be the master of ceremonies for that. I think there should be,
thank you, Jesse.
for those who are signed in. Yep.
Yeah, thank you so much, Jesse. That was an excellent overview of a very complicated topic, and we do have questions streaming in. So I'm just going to go ahead and start. We have a question from Jaideep, who works with Paytech in India. And his question is detailed, but he's basically concerned with how to build a scalable business model using mobile that addresses key concerns, keeping transaction costs low, minimum paperwork, and that are tailored to the consumption pattern of the targeted population.
Yeah. Okay, that's a great question. Thanks, Jaideep. I think you've actually hit the nail on the head, and that's one of the things that we really focus on, because even though technology often, when we discuss mobile banking, because there is a lot of technology involved, we found that technology is not really the hard part. Technology exists. People are using it. It's available. It's out there in the universe. The challenge is the business model, and I think that goes to the heart of what Jaideep is asking. And we see a number of different business models emerging, many of them in response to peculiarities in the regulatory environment. Jaideep being from India, we work very closely with a number of partners in India, and the Indian regulatory environment is very specific, as is the regulatory environment in Kenya or Bangladesh or Mexico. And so you see, in many cases, very different types of business models being deployed. Those typically fall into 4 different categories in our experience. And I do have a slide on this, but I don't have access to it just now. It's okay. The one is sort of a bank-led business model where that's permitted, where you would essentially have a commercial bank building its own payment network. And a good example of that is United Bank Limited in Pakistan, which operates the Omni Payment Network, which is a national network. They developed in-house technology, software, a platform that could really transact, whether it's telco agnostic through SMS and IVR, voice recognition technology, or cards technology, or even internet, though that's not really targeted to the basic pyramid segment. And they build their own agent network, and they operate that network in conjunction with the operating system to deploy that. And for them, that works. They've been able to piggyback on the core infrastructure of a commercial bank. They're able to service their agents fairly efficiently because liquidity management is not a problem for them. They know how to do that. They have access to those services and can support their agents. And the incremental transaction cost to do that is very low for them, and they're able to make that available to their clients. Another model is the agent aggregator, which might be more familiar to Jaideep, because in India, for example, the business correspondent model is where a lot of focus has been. There have been some constraints and obstacles to that model going to scale in India, but essentially the concept is essentially that a third-party private company would build an agent network and either partner or acquire or develop their own technology to facilitate transactions and link into the front end, whether it's remote, and the back end, typically a bank, to provide those services from the bank or other partner to the client who is engaging in that system through the agent that aggregator essentially owns or operates and manages and leases access to banks and other partners. and that's a feasible model. There's also the third-party company model, which bKash in Bangladesh is a good example of that. It does have bank involvement because of the regulatory requirement. But again, there they have a national agent network. They have operating systems, branding. They have a mobile wallet that they can basically, any bank that wanted to, or financial institution that wanted to offer their own mobile wallet could do so. So it would be powered by bKash, fairly similar to powered by MasterCard or powered by Visa in that sense. And customers could access that wallet linked to their financial institution of choice through any number of the 23,000 agents that bKash has deployed across Bangladesh. And then finally, the telco-enabled model, the most famous of which is M-Pesa, which essentially is a payment-driven model linked to their current infrastructure, their current agent network. M-Pesa is quite remarkable in the payments field because the current statistics are that fully one-third of Kenyan GDP moves through the M-Pesa system each year, which is really quite astounding. That's again can be fairly low cost to the provider. One of the questions, of course, inherent to what you just asked, Jaideep, is if a system is low cost to the provider, how do you ensure that it's low cost to the user? In the case of M-Pesa in Kenya, because of the lack of competition, it's actually fairly high cost to the user, particularly for low balance or low value users. The cost per transaction, for example, for M-Pesa, for the lowest tier of user can be up to 30% of that transaction. So not unlike Western Union is currently. In our experience, we see that the more the competition exists in the market, the better the benefit to the client, which is perhaps no surprise to anyone. But I think it is important that the business model itself, as you asked, really is sound. All of the business models, to a greater or lesser degree that we've seen, rely very strongly to be effective on partnerships, and on partnerships that work for each individual partner, including the individual agent, the small shopkeeper, because they have a core business. They're selling other products, and if they take away time from selling rice to selling bKash or whatever other mobile money product, then that has to make sense for them if it's going to be successful. And one of the really areas of important emphasis is then thinking about how to structure the pricing of the different models so that your customer is responding in the way you expect them to, so the agent is responding in the way that you expect them to, and on up the line. If you're working with telcos, you need to factor in the fact that they're going to want to charge you for access to their system, particularly if you're using a very closely locked-in system. Not to get too technical about it, but for example, a USSD channel, which allows for you to use a menu on a cell phone as opposed to sending in codes or SMS, which can often be easier to access, but really give more control to the telco. And in that case, they're going to ask for more share, probably, of the revenue. And so that has to be very carefully considered and can be quite costly. Often, particularly when we talk to MFIs, or even commercial banks who approach us and say, look, I know mobile banking is out there. I need to do mobile banking. I need to build a mobile payments platform. One of our first conversations with them is, well, timeout. First of all, why? What do you hope to accomplish with this? What is your objective? How is this going to improve access for your clients? How is this going to improve your ability to deliver the kind of products that you think they need? And are you really prepared to be in this for the long term, and how much are you ready to invest in this? Because if you're going to build the sort of the rule of thumb for a full mobile payments platform, to build it from scratch, you have to have at least 20 willing and able to invest in that. And it's a long-term thing. It's not something you do in a few months. It's something you do over the course of several years. And $20 million is actually probably on the low side, I would say. However, many of the business models, again, not to stress the point, but partnership is key. And once platforms have been deployed, it's in the interest of those platform operators, and it's in the interest of individual microfinance institutions and other partners to link, to forge partnerships. Because we're a platform provider, their viability is only so strong as their ability to bring on more services that add value to a greater number of people. And for a partner financial institution, obviously they have the opportunity to potentially benefit from the economies of scale of a national platform provider without having to make that huge but essentially able to use that platform as a utility channel to accomplish their objectives, serve their clients more efficiently and at a greater scale. Yes.
So, Jesse, we have about 7 or 8 other questions. We have about 15 minutes left, so
okay.
I'm going to push those questions through to you.
I can't see them, so.
That's all right, Jesse. That's I think it's a complicated issue that requires a long answer. I hope that helped answer your question, Jaideep. I'm going to switch gears a little bit and ask a little bit more about how it works. I have 2 questions I'm going to try to combine into one. So John asks, can Joe, in your example, open a bank account with his phone, or does he need to go to the bank physically? And does this run into anti-money laundering regulations? And then Kathy asks, what does the agent do with the funds that he or she receives? So if you can talk a little bit more about that.
Yeah, great questions. I'll try to be briefer, though those are also questions with a lot of depth. So in terms of opening an account on your phone, the answer is in certain cases. And again, it goes back to the regulatory environment. So for example, in India, the regulatory environment requires, it allows for that process to begin at the agent, but it does require a visit to the bank. And it does require a verification of a significant amount of paperwork by the bank and through the banking system. And that's true in other markets as well. Pakistan, I think, is another example where the regulator has created a different level of requirements, including anti-money laundering, basically pegged to the value of transaction or account balance that is passed through that frame. So basically, what they call a level 0 account in Pakistan, you can go to an agent with your phone, open an account, and transact on that account all within the space of 10 minutes. And then there's a KYC verification that occurs over a 24-hour period, after which you're assuming that that's authenticated and cleared through the electronic channels of the central bank. Then that account holder can transact as much as they like within the constraints of the account balance limitations for that level 0 account. And all of that happens at the agent or on their phone. There's no interface with the bank. So I think those are kind of the two extremes in terms of the regulatory environment. And I think the regulators generally are moving towards the latter. They're realizing that you can't have the same kind of requirements for someone walking in and trying to deposit $100,000 into an account as who needs to deposit $3 into an account and kind of use their account within that same kind of parameter. And in terms of what the agent does with the cash, I think the brilliant thing about the agent network model is that the agents are already handling cash flow, inflows, outflows. So it really, in the best case scenario, it really just taps into the existing flow of that agent. They're taking in cash in exchange for products and services that they're selling in their local corner shop, and in this case, the participation in the mobile payments platform actually helps them to manage the balance of cash that they have on hand, because they're giving out cash instead of having to keep it safe somewhere in their shop to the end of the day, or at whatever point they can get it to the bank or some place to keep it in safekeeping. Now, in certain instances, we find that particularly with remittances, so for example, Joe was sending money home to his wife Sally in the countryside from his place of work in the city. Often that does create a cash imbalance, and that's why an important focus in many of these models is on liquidity management. And a key aspect of what the mobile payments operator does is ensure that they understand the patterns, liquidity patterns of their different groups of agents. So, for example, the agent in Dhaka, often at the end of the week, they have a huge inflow of cash because everyone is getting paid and trying to send money back to their families in the countryside. And the agent in the countryside has a giant sucking sound because all of the family members are coming at the end of the week to withdraw their cash that's being sent to them from their relatives in the city. And so the liquidity partnerships that they have to develop really need to ensure that cash is where it needs to be at the right time and the right value to ensure that nobody ever is turned away because they can't get their money out of the system or they can't get their money into the system. And there are a variety of ways to do that. Many partners that we've seen work with microfinance institutions to help with that because microfinance institutions are already have expertise in that kind of cash management. Some partners work with commercial distributors, Coca-Cola, shampoo, soaps, rice. They already provide those cash management services to their shops in many cases and are happy to do it for a small portion of that revenue for those agents that are working with a full payment provider. And there are other examples as well, but I think you've hit on the nexus is that making sure that cash is available to the clients when they want it and need it is very critical to the viability of the payment system because you're asking them, particularly in the early days, to demonstrate quite a bit of trust. And that's a very important part of this transition to the mobile payments.
Thanks, Jesse. I'm going to try to get to 3 more questions here. David Messenbring asks about the mention of the importance of partnerships. And he's concerned, he says, what's being learned about the importance of near monopolies, like perhaps M-Pesa in Kenya, being present in geographic spaces before cost-effective scale can be achieved?
Yes. Well, I think some things are being learned, perhaps not as quickly as they could be or should be. But there is, I think, a growing awareness of that. I mean, one of the reasons that M-Pesa was so successful is that it was a monopoly, or is a near monopoly. And that, certainly helped in terms of the ability to go to scale and have ubiquitous brand presence. But I think that's also been one of the reasons that the M-Pesa may replicate in whole to other markets because other markets are much less monopolistic in their structure. And I think we're seeing in places where there is more competition, there's also a lot more innovation in partnerships and in products and services and in how these platforms evolve. And it can be quite different. Peru has a very different type of model where you have, it's actually not mobile-based really at all. It's primarily driven by strong networks of point-of-service devices that are operated by different types of banking and micro banking financial institutions. And interoperability starts to become a part of the conversation because if you have a closed network, that's less useful to the client. And ultimately, I think what we're seeing is that as I'm more familiar with these systems, they begin to push the envelope in terms of demanding access and driving use as well. In Bangladesh, bKash had the experience where they realized it was imperative that they have multiple telco partnerships because clients did not want to be locked into one single telco provider. They wanted to be able to move from telco provider and still be able to access their account. And so bKash was obligated or obliged to form those types of partnerships to ensure that they could keep their clients happy. And that's an enormous thing, because when you talk about whether some of the root issues or elements of poverty, many of them boil down to choice and control. And I think that's a critical element of what we're seeing happening in the mobile payments. It's pushing choice and control more and more into the hands of the low-income user of those services. And we see that as a good thing. And I think that's going to continue to be a strong driving theme as this industry, a new revolution, if you will, continues to develop.
Absolutely. Sheila Oviedo has a question about some of the risks associated with mobile banking, and I'm sure that there are many. She mentioned several concerns, but can you kind of touch on some of the risks associated with mobile banking, in addition to all the opportunities and benefits that you mentioned?
Yeah, I think we might have to schedule a whole additional webinar to talk about the risks, because it isn't, again, as we touched on in the response to Jaideep's question as well, there are a number of different business models, a range of regulatory environments, and quite a bit that's still unknown as well. And so that combination of things creates very different types of risk universes, if you will, in different markets. So, for example, to take one set of risks, and people often focus on sort of the risk at the agent level, and saying, well, what's to keep the agent from just taking the money or misinforming the clients? And that is a concern, and there are ways around that level of risk, which include sophisticated technology and biometrics and authentication capabilities, as well as more basic printouts and receipts and things of that nature that clients can be trained to expect to receive at the conclusion of each transaction, and even just the human the human element of it, which is the fact that agents are members of that community. Typically, they know all of their clients, and all of their clients know them very well, and they've lived together, and they've had years, if not their whole life. And that's an important element of that risk, which is often one of the core focus areas. The areas that I think become more challenging have to do with sort of how the value that is on the system is regulated and managed. So, for example, in a telco-only configuration, there are a number of risks. First of all, there's no, for value that's put into the system and stored on the system, there's no real recourse if, as happened recently in Uganda at a telco operator, some enterprising, so to speak, employees made off with a couple $1 million worth of stored value. There was no real ramification for the telco, because they're not a bank, they're not a financial institution. The regulator can't punish them for losing the deposits of their clients. They could and did go after the individuals and try to arrest them and throw them in jail. In that case, the value was only a couple $1 million, which was certainly easy for the telco operator to pay up out of pocket. Now, at such a point as that happens at a larger scale, that becomes a very different issue, and that's one of the reasons that we see the drive towards stronger involvement or requirement of involvement by the regulators of financial institutions in the system. The other element of that, of course, is that in many cases, telcos have no limitation on how they issue value. Airtime is actually a value. It's a currency in a way. And if there's no requirement that that value is balanced in the real economy, then that becomes a significant potential issue and risk as well. At a very minimum, it makes it very difficult to make the system work at a broader level, because a telco that has issued a bunch of airtime value to its clients doesn't want to see that client taking that value to another telco provider or competitor. Risks in terms of the different systems that have to speak to one another, going back to the theme of partnerships, in some of these more sophisticated deployments to make a transaction happen, to manage an account. And currently, there is often not a consistent level of security across the systems. So security on a telco channel that's communicating to a bank backend, that bank backend may be very secure because they're required to be. They have regulatory requirements to protect client information and so on, but the telco channel is not. And so there are risks there in terms of how information can be misused or accessed in ways that might not be in the interests of the clients. So I think those are a few. There's a whole other range of risks that are implied. I think we see that the regulators are thinking about and addressing these risks proactively. They realize that this is a whole new universe in terms of the positive of financial inclusion is that millions and millions of people who have been excluded come onto the system. The negative is that the systems are not built to serve that full scale of financial inclusion, and so there really has to be a rethinking of the whole infrastructure, and that is underway in many of the key markets where we're seeing innovation occur in this space. But I will say that I think we have to be prepared for setbacks. Those are going to happen, and it'll be important to learn from those quickly and to apply lessons just as quickly, because I've had conversations where people have said to me, well, but if somebody's got $10 on a mobile platform, their savings, low-income person, use it for whatever reason, and it's not a big deal. It's $10. And I say, well, that may be true for you or I, and I don't know. I mean, I value my $10, but for someone who's making less than $1 a day, $10 is often a significant amount of savings, and having that put at risk is not an acceptable option for them, and it shouldn't be for any of us who are involved in helping to structure and build out these systems.
Thanks, Jesse. I think that's a fantastic way to wrap up today's presentation, and I'd like to ask you if we can check back in with you in a year and see where we are as far as the mobile banking and financial inclusion initiative is going.
Absolutely. It would be my pleasure, and I'm sure there'll be a lot of new things to talk about a year from now, because it is happening very fast.
Well, thank you so much, Jesse. Thanks for taking the time, and thanks to all of you for spending your lunch hour with us.